right, so I want to talk about three other pieces of economic information that came out on Thursday and Friday that didn't get nearly as much coverage in the financial media as the non-farm payroll number, but which I think are far more significant than that number as an economic report card on the health of the U.S. economy. One was the productivity and cost numbers that came out on Thursday. And in fact, this is the number that might have sparked the new record high in the price of gold. I don't know. I think the futures contracts might have traded at a record. I don't think the cash did, but we came pretty close on Thursday. And I think this number was part of the reason. But non-farm productivity dropped by 2.7%. That's a big decline in productivity. The expectation was for unchanged, which is still not good. You want productivity to go up, but you don't want it to drop by 2.7%. I mean, that's pretty bad. Now, in the prior quarter, it was at 1.7, and they revised that down to up 1.6. So that's still not great productivity growth, but minus 2.7 just, got rid of whatever productivity growth there was. And one of the main reasons that productivity was so low was a big jump in unit labor costs, which were supposed to rise by 3.9%, and instead they spiked by 6.3%. That's a big jump in unit labor costs, and it's a much bigger than the prior quarter, which was just slightly revised up from 3.2 to 3.3. Now, some people will think, oh, well, that's good, right? Labor costs are going up. That means workers are making more money. Not necessarily. Number one, because labor costs involve a lot more than just wages. They involve benefits. And if benefits get more expensive for the employer, that may not necessarily be a positive for the worker, right? Let's say a worker is getting health insurance from his employer, and the employer now has to spend more money on that insurance policy. Well, I mean, it doesn't affect the worker. I mean, he's got the same policy, and if his boss is paying more money for it, that doesn't mean he's better off. Now, of course, the boss may end up having the worker cover some of those higher costs. Maybe they end up with more higher co-pays or higher deductibles. So that's not in these numbers, but that may be happening. But whatever extra health insurance costs the employers have to bear, well, that's going to be part of labor costs. But also a lot of rules and regulations and other components go into labor costs. What the workers actually get is just one part of an employer's overall labor costs. And in fact, if labor costs are really going up, that might result in the employer trying to squeeze workers to earn less or to get a smaller raise because other costs are going up. Because if you have a job, all of your costs of hiring you, you need to have enough productivity to cover that. Because someone's not going to hire you if your productivity doesn't exceed the total cost of employing you, which is not just your labor, but all the other taxes and regulatory costs that governments add to your wages, and you have to be productive enough to cover all those expenses. So rising unit labor costs like that are bad. Now, especially if you are hoping that inflation is going to come down. Because one way the official measures of inflation, the CPI, one way to keep the CPI from going up is to have growing productivity. Because as productivity increases, costs come down. And that allows the government to create some inflation that doesn't show up in the CPI. Meaning, let's say we're so productive, our productivity is so high that prices would have come down by 3%. But the government creates a bunch of inflation, and instead prices go up by 2%. Well, we have 5% inflation, but you only see 2%. because you don't see the price cuts that never happen. Or another way to put it, let's say inflation would have been 10%, but because of rising productivity and prices, let's say they would have dropped by 5%, and now inflation's only 5%, at least that's what's reported. So rising productivity makes these inflation numbers look good. But on the other hand, if we're getting falling productivity, it's going to work in reverse. If productivity is going down, well, then prices might be going up based on falling productivity. Then you add inflation on top of that, and it makes it worse. So if you're hoping that you're going to get lower CPI numbers, you need to hope for more productivity to basically reduce the inflation that the Fed is creating, to help get the Fed out of jail by the economy lowering costs in the face of the Fed's inflation, which is raising prices. But if productivity is not helping out, then that goal is going to be much harder for the Fed to achieve. And of course, all this talk about wages going up, people want to talk about wage increases. Those are nominal. There's only one way that you can get real wages to go up, and that's if productivity goes up. Workers have to be more productive to earn more. If they're not more productive, it's impossible for them to earn more. They can only earn more if they deliver greater productivity to their employer, because that's the only way their employer can actually pay them more. So when you see falling productivity, you know that real wages can't go up. In fact, they have to go down in order for people to maintain their jobs. Otherwise, they're going to have to get fired. So this is bad news. It didn't get a lot of coverage, but it should have. Now, another data point that came out, which I think was also important, that they kind of mentioned, is consumer credit. And this number came out on Friday, so the same day as the jobs report. It just came out later, like 3 o'clock in the afternoon. So, on a Friday, maybe people have already, left for the weekend, and so they're not really paying attention to numbers that come out at 3 o'clock on a Friday. But the consumer credit number, the expectation was for a jump of $17 billion for consumer credit. And the range of estimates was 15.8% to 18%. And the actual increase in consumer credit was $26.5 billion. This is a huge number, big jump in consumer credit. It was well above the $15.1 billion increase in consumer credit from the prior month. Now,